Hello, this is Raymond Shapiro, Portfolio Manager of the Merchant West Global Equity Fund. This is the quarterly report for the period ending 30th of September 2023. The fund marginally fell by 0.2% in US dollars over the quarter, outperforming its benchmark, the MSCI World Index, which lost 3.5% over the period. The MSCI Emerging Markets Index fell 2.8% over the quarter. Global markets retreated during the quarter on fears of higher for longer long-term government bond yields and dimming growth forecasts. The technology sector contributed most to the decline. However, all sectors other than energy and communication services posted negative returns for the period. Fund returns were driven by holdings in the communication services sector as well as by holdings in the energy and consumer discretionary sectors. The fund's exposure to technology, staples and industrials were the major detractors from returns over the period. Major stock-specific contributors to performance included Booking Holdings, Novo Nordisk and Alphabet. Major stock-specific detractors included UK wealth manager St James Place, Microsoft and Roche. Market overview. Globally, the third quarter of 2023 started off on a positive note as inflation data in the US for June came in at 3% year over year, lower than expected. This prompted optimism that the US Federal Reserve is nearing the end of its monetary tightening cycle, with investors choosing to focus on when interest rates may start falling amid signs that inflation is waning. The optimism in financial markets, however, was short-lived, as further signs of weakness in the Chinese economy began to surface. Furthermore, consumer confidence in the US began to decline after having reached a two-year high in July. However, continued hawkish comments from the Fed sparked renewed fears of another interest rate hike in the US due to stubbornly high inflation. Investors now fear the interest rates may stay higher for longer than what the market was pricing in. The situation was exacerbated by oil prices rising 25% over the period. US Treasury bond yields across the curve spiked sharply over the quarter, with the 10-year Treasury yield reaching a 15-year high of 4.75% at the end of September, rising almost 100 basis points over the period. While consumer prices in the Eurozone and UK have begun to slow, inflation is still significantly higher than their respective central banks have targeted. Both the European Central Bank and the Bank of England raised rates during the third quarter, with the higher rates resulting in continued slowdown in our economic activity for both regions. Portfolio strategy. Two prominent features of the current global investment environment are the risks surrounding higher for longer long-term interest rates and material global growth uncertainties. Furthermore, geopolitical tensions and conflicts across the world continue to sap confidence and undermine international trade, a major driver of growth. As previously highlighted, a further risk that needs to be carefully monitored is the effect that the rapid rise in global interest rates will have on borrowing costs across various stocks and sectors, especially those employing significant leverage. Our view is that stock-picking quality businesses is set to become increasingly important as higher interest rates and borrowing costs affect companies differently, and changes in competitive intensity and disruption is having very different effects across specific companies. Cognizant of these risks, we seek to invest in businesses possessing strong pricing power, appropriate leverage, defendable margins, and resilient growth prospects that also trade at reasonable valuations. We continue to assess company gearing levels carefully, factoring in the risk of the recent interest rate increases on profitability. We look to invest in companies with predictable cash flows and strong business models, able to withstand economic downturns. These criteria, we believe, provide the fund with the ability to weather challenging economic times. Ours is a risk-controlled, stock-picking approach, which we believe equips us well to take advantage of attractive long-term investment opportunities as and when they present themselves.